I'm leveraging basically what I'm good at, which is look at the chart and try to think and have a very analytical mind. Market sentiment is a great factor, a great category to look at because now trend following by and large works, but it will be very, very difficult to find something that is more than 35-40% accurate. So the top of the market, and then you can see the commercials were selling at that point. Oh yeah, it makes absolute sense. And then you see the market falling, commercials were buying into it, then it reverses, but you're seeing it on hindsight. The most important message is just see what you're good at, see what you're not good at, and then try to leverage what you're good at and avoid the other one.
Welcome back to the Edge Builder series, where we take some of the best traders in the world, dive into their edge and how it works. So, my guest today is Mr. Alex Spiroglou, legendary technical analyst, award winning, and long-time trader. Alex, great to see you.
Great to see you again, Colm, my dear friend. It's the second time I'm here at your podcast. It's a pleasure, of course, to speak with you, and also happy I can bring some value. Although I don't consider myself neither a guru nor legendary, I'm just someone who likes what they do, and I hope that I can bring a bit of value to the conversation today by sharing um, my scars so people avoid having wounds.
Hmm. Yeah, well, I mean, I feel like this series is all about edge, and I think our first interview on the podcast was probably one of my most viewed interviews, and I got a lot of feedback about how structured your trading came across, how many models you have for different things. So yeah, you're the ideal guest when we talk about just fundamentally how do you create an edge, because in trading, I think it's kind of the most important place to start, I think.
Absolutely, yeah, it is. I've always had a need for structure um, because I'm not a very good discretionary trader. One of these that react to numbers or have a feel for the market. I'm not a good intraday trader, but I've always had other abilities or other innate, talents, if you will, which I had a very, very analytical mind, and also liked to see things from a different point of view, open the hood, if you will, of or the bonnet of technical indicators, or ask the right questions and create tools that solve problems. And this put this in a step-by-step framework. And that was my talent. So I thought, okay, I'll just focus on the things that I'm good at and avoid the things that I'm bad at. And of course, I wouldn't ask someone to be cloned, for what I do. Perhaps provide a bit of inspiration, but the most important message is just follow what I did, in the sense of see what you're good at, see what you're not good at, and then try to follow to leverage what you're good at and avoid the other one.
Hmm. Yeah, it's important kind of awareness to have about your strengths and weaknesses. And good reminder, it's funny when you say, I'm not a very good discretionary trader, that, generally humans aren't, but everyone, when they start, thinks they should be a good trader for some reason. But it's such an inhuman activity.
It is, and to mention that discretionary trade, being a fully discretionary trade, because I would classify myself as someone who's semi-systematic, in the sense that I'm um, rules-based discretionary. So I do have a discretionary element to it, but there is also a systematic, and I found that's the best style for me, rather than being fully systematic or fully discretionary. And again, it's just a matter of self-awareness and self-discovery. And you'll find out what you're good at and what's more compatible to your character, what's more compatible to uh, your psyche, and then work on that.
Hmm. Yeah, absolutely. So let's dive into it then, on our first key question, which is, what is your edge in trading?
Basically, my trading philosophy has three pillars. The first pillar is that macros matter. Although I'm a technician, a card-carrying member of associations, and I've been a technician, fallen in love with technical analysis. I first got to know about it, I think it was 1995. uh, yeah, 1995, 96. Um, I do believe and know that macros matter. As much as we technicians love to think that the be all and all of everything is like trend lines and patterns and stuff, that really doesn't happen. So markets move from point A to point B because of macros. So that's my first edge, if you will, that I try to focus my directional bias on macro because that's real. My second edge is that I have multiple time frames and multiple factors. And what does this mean? That as we all know, and, especially as technicians, that there are multiple time frames, and my operating time frames is the monthly, the weekly, and the daily chart. So the second part of the edge is that I have isolated different factors that different return drivers, if you will, that affect different time frames. So, for example, on the monthly chart, I check out the business cycle, as you can define it through either economic statistics or intermarket analysis. Then I go to the weekly chart, which you can find other factors like commitment of traders report, sentiment, seasonals, and so on and so forth. And then I drill into the daily chart with all the beautiful tools of technical analysis to do my timing, if you will, because macros
Mm.
answer the question why and technicals the question when. So the edge, if you will, is that I combine these into a framework that merges both macros and market into a step-by-step roadmap, if you will.
Mm.
And of course, the third component of my edge is everything has to be rules based because again, circling back to what I said initially, I'm not a good, fully discretionary trader. Price action, seeing what the market moves and having a feel for it. It's not my game. So, but I did find that once I was rules based and I had black and white boolean logic, if you do this, if then analysis rather than what if. I'm not very good at scenario based, what if Trump says this or XYZ this happens and then it's not my thing. I mean, some people may have a talent for it, but it's not me. But when I switched to if then analysis, then if that happens, then that, and do now casting instead of forecasting, I found it much more um, in tune to my psychology. So again, went to rules-based trading. So that's my edge, the three pillars of my edge: macros,
Mm.
different markets and different time frames, multiple factors, and then having a rules-based framework. So that's it.
Yeah, I love that nowcasting versus forecasting. Haven't heard that before, but I can relate to that and the that what if component versus if then. I really like that mindset because even when I want to get a little bit to dive into the macro that you mentioned, but when people are again doing that forecasting exercise, for example, trying to do a type of event driven strategy, if non-farm payrolls hits two standard deviations above the expectation, I expect euro dollar to move X amount. And it's very hard to say. I mean, you can have some kind of back test behind it, but forecast what exactly euro dollar is going to do. So when people have that attitude, again, it's anything that starts to look into the future where the best people in the world find it extremely difficult to get right most of the time is not a great place to be. So I like that nowcasting. Yeah, really like that.
Absolutely, and it makes sense. I mean, even if as you mentioned, you quantitatively, you basically you check the stats of a particular strategy, and you can trade off of it. It's one thing rather than just having an instinctive. I think that, to tell you the truth, to be honest, I think the number of people who can instinctively feel the market are probably counted on the hands of a severely mutilated hand. I've known a few people like that, but they have an extreme talent. I'm not one of them, but they are very, very far, very few, very few.
Mm. And on that rules based, it's one big thing I really like about your trading, and just when you're learning from someone, one challenge I came across as and being someone that started in the kind of world of macroeconomics and geopolitics and its impact on asset classes and that kind of world. Um, when you go to learn from a mentor that focuses on things like that, the central bank speak, just the finer details of the world of macro, whether it's economics, etc., how it should impact the currency. There's so much fine detail and understanding and years of discretionary decisions, and basically someone that's using a lot of their experience and you're trying to learn from them. And it's very, nothing's down on paper. We use this level and we use this and we have a bearish view on the dollar that's based on 15 different macro things, all of which you can't quantify. Your approach, I think, is like the stark opposite of that, where you focus on the macro that you can measure, as well as being systematic with technicals, as well as being rules based, right?
Yeah, I think yeah, it's quite important. It just fits my personality. And to tell you the truth, Colm, it's not just um, if someone has a talent for it. It's not reproducible. It's not teachable
Mm.
because it's something that you have and that's it. While being rules based, it's something that you can show someone. You can tell them, look, if you're got that, then you do this. If you got that, you do that. So that's also teachable, and that's also very important for people because if you someone wants to acquire a skill, you must do so from someone that has a rule book, a methodology that you can learn initially, then start practicing. You can't just say, okay, watch me, and then hopefully it will may rub off on you. It doesn't. It's not teachable.
Hmm. Yeah, that's the key. I think it's how to pass it on without having to live a 30-year career that it took you to learn some of these things, the softer stuff. Yeah. Um, like on the macro point you mentioned, right? On the monthly chart, you look at the business cycle. So can you talk a little bit about how that works then? Because for some people that wouldn't know what the business cycle is, or why on the monthly you think the business cycle is appropriate, or something you take as an indication for your trades.
Business cycle is basically is sets the tone for everything else. Let me actually circle. Let me say something else, then I'll circle back to connect it to the monthly chart. One of the big things I'm a proponent of is diversification, and one can diversify across strategies, markets, and time frames. Strategies, return drivers. So one of the things I try to do as part of this diversification principle is what I call a core and satellite approach. A core is basically I have a long-term positions on ETFs, basic anything that's non-leveraged, and then do some futures trading, short-term positions. So that's my satellite approach. So the monthly chart actually relates to the core part of the portfolio. So it's like a setup, the monthly for the weekly positions, if you will. While
Hmm.
the weekly chart is the setup for the daily positions, the short-term futures trading, while the monthly is the setup for the long-term weekly positions. So that's how it relates. Because someone could ask, and it would be a very good question. So, okay, so if you're doing short-term trading for I don't know 3 to 4 days, why would you look at the monthly chart? Um, there would be very little relationship between these. But if you do long-term position trading on the weekly chart, then the monthly chart becomes very uh, relevant. And now, come back to the question. You can, no, you can. That's how I look at it. I look at two things: either the economic statistics, which again I've tried to quantify. Again, for example, is inflation high or low? Okay, you can quantify that. Say put a shorter moving average on it, and say if it's above, inflation is rising, and put some levels, and then so on and so forth happens to the S&P 500. Or you can study the correlations between the asset classes. There is a lot of work done on that already previously by people like Martin Pring, John Murphy, um, And there have been, a lot of analysts who've done that. So you can quantify the stages of the business cycle as viewed not by the economic statistics themselves, but by the markets, because different asset classes relate to different stages of the business cycle. So, for example, um, the first asset class to bottom during a recession, or actually, is bonds. So there is a rotational sequence that goes in the business cycle. The first asset class to bottom is bonds. Um, so then it stocks. Usually they say 6 to 9 months before the actual uh, recession is over and the recovery starts, and then commodities come as a more of a lagging indicator because there has to be some kind of a physical demand for the products for before the economy starts heating up again. So there is this rotational sequence. Basically, there are 8 stages to the. If you do the math behind, one market is up, one market is down, then the third is up. So you've got 3 markets, basically 8 combinations. And when you take these combinations, you can see the stats behind it. I mean, what's the annualized returns, how much time there is in each stage, and by and large, not always, you can see this rotation being followed by markets. Not always, but as a simplification on an idealized chart, you can see it. Bonds, then stocks go up, then commodities go up. So there is a stage when all 3 asset classes go up. That's the best. Then, being the most inflation sensitive, uh, bonds go down, then stocks, then commodities, and there is a stage where everything goes down. So through the asset classes, you can see what's the expectation of markets. You can see what's the business cycle through the market's point of view.
So how do you extrapolate the market's point of view there, right? You say, so for example, we look at the business cycle in terms of economic statistics, and then we talk about, uh, say, as you call it, intermarket relationships, which I do believe in. Definitely think that. I mean, when you see the flows, I think it's a little bit undeniable. But when you say pairing the statistics with with the actual market movement. So in that case, we have maybe inflation falling, interest rates will fall, and then you're looking for signals of a bottom, I guess. And you look, so you see economically where growth is, and it's in recessionary territory. And then you're looking at what the price of bonds or how much they're moving. So
Well,
you
there
think
there
that
are
you're right.
many. Well, first of all, you've got what they call indicators, and then you've got models. An indicator would be, for example, a one-to-one relationship of a variable, such as, like, say, let's take inflation, and then you quantify inflation. What is its effect on, say, for example, bonds or stocks, and say if the inflation is rising. Okay, let's put a shorter moving average on inflation, and say if inflation is rising, how do bonds or stocks behave? Or you can say if it is above a certain level, how do bonds and stocks behave? So that's a simple indicator, one-to-one relationship. Now, because markets, of course, and economies are not that simple because there are many variables, then you can bring many indicators and create a model and say, so what one component is me might be inflation, what might be industrial production, and so on and so forth, and see what's the composite of it, create what's the effect of it, and you can relate that to a particular market, and then you can see what is the relationship between these the major 3 asset classes: bond, stocks, and commodities. There are many ways around it. It's just choosing the one that you think makes more sense to you. I think that was the one that made more sense to me. For example, you can correlate and see, if bonds are down, stocks are up, commodities are up. What are the annualized returns based on this pattern, based on history? History doesn't, of course, always have to repeat, but you can find that there are good tendencies on that. And based on that, you can see that it's much better if I take positions in that asset class rather than another one.
Hmm. And how long do you, so say we have that situation, stocks up, bonds down, commodities up, and you say then that Do you extrapolate that that may continue for the rest of the year? And if so,
No,
I mean, what
no,
kind of?
I do not. I do have, well, basically what I do have is I have, you can find stats how long that lasts for. But each cycle is a bit unique. I mean, there are general tendencies, but I find that each cycle there is a unique and unexpected part to it. So that's why I'll always have stops, and I don't make an assumption that the average number will be relevant in this particular case, because averages are just that. I mean, you have a maximum and a minimum, and the truth is somewhere in between that. So that's why
Mm,
that's when analysis and technical analysis and macro stop, and then real world risk management begins.
mm.
So yeah, it's a guide, but at the end of the day, I mean, you have to have your stops to dictate. If the market says otherwise than what its usual behavior is, then you'll have to go with that.
Yeah. Okay. Very good. And on the weekly, then you mentioned kind of you look at things like the COT report or the Commitment of Traders report, the seasonality. And what are the other things you focus on
And
the weekly?
sentiment, market sentiment.
Sentiment.
Market sentiment is a great factor, a great category to look at, because um, it has a reverse relationship with liquidity. Because when a lot of people are feeling bullish and that have manifested that bullishness into a long position, that means that they're more and more and more invested. So there's a lot of people who left to invest. So it's a great contrary indicator at extremes, but also a great trend following indicator in between, because I follow market sentiment at extremes as a contrarian, and in the middle as a trend following indicator. Now, that's as a matter of principle. Um, there are many sentiment indicators to follow. So what I've created is what I call the smart sentiment indicator, which is basically a composite of various um, individual sentiment indicators, which I follow as a trend following indicator up until they reach an extreme, and and try to use in conjunction with the other tools. For example, you mentioned the commitment of traders report. When I see a lot of commercial accumulation, and I also see that there is extreme bearishness from a sentiment point of view, then you have a lot of odds for the market to turn.
Mm.
Again, these are all great tools. I had other people teach me these, and then it took a bit of work trying to improve what I've already learned. And but that's basically, I wanted to use many factors how to try to look for an edge, since we are on the issue of edges, and then
Mm.
use seasonality as a timing tool, because especially in commodities, but there are recurring business patterns as to, for example, when there is plantation or there is harvest, there is, or if a commodity is more, because some commodities are more supply influenced, more are more demand influenced, but there are some commonalities within the business cycle, again relating to the first question about the business cycle, when there
Mhm.
is more increased demand and or there is increased supply, so it creates upward or downward pressures on price, and that shows up in seasonality.
Yeah, I wanted to mention that that concept of having multiple kind of signals from different sources. I think Stephen Hoad said something like it's called collinearity, something like that, where you have multiple things pointing to the same outcome, right? So I think that's quite useful. And so these market sentiment indicators, are they just freely available? I know you've created your own one, but where do you find I don't think I've ever seen a market sentiment indicator.
Well, most of them are the data are paid, it's called alternative data,
Okay.
but some are also free, because for example, in the category of market sentiment, you can include other categories, for example, like market breadth. Now, that's not exactly a market sentiment indicator, but it can show you the sentiment in the large sense. For example, how concentrated the flows are in a few sectors on stocks. Now, very good, very well-known breadth indicator is the number of stocks above a 50 or a 200 moving average. And of course, you can do the equivalent for bonds. You can do the equivalent for commodities. For example, you can take the top markets in, for example, fixed income. Do a breadth indicator on bonds, or you can do breadth indicator on commodities or currencies against the US dollar. So market breadth goes to show you how concentrated a move is, and if there is uniformity against it. For example, take the S&P 500. It's very different if a market is rallying with a lot of stock, with say 60% of the stocks or 70% above the 50 or if say 200 bar moving average, rather than being concentrated with a few. You can see market rotation, and when there is a lot of participation across the board, then market sentiment is a lot more bullish. So breadth is one type of sentiment indicator. And then you've got other which are more on paid data, which is basically what either people say or what people do. For example, like cash reserves, or you can use other freely available data like put call ratios. Again, this is also market sentiment
Okay.
indicator. There are a lot of data sources. Some are free, and some are paid. So you can work with both. Each one has its own advantages. Each one has its own disadvantages. They don't always speak. That's what I always thought of, creating a composite indicator, which tries to give me a more uniform view you know of market sentiment rather than relying on one, because an indicator can be either wrong at sometimes, or it may not speak. For example, you can have a top, but it doesn't mean that this particular indicator will show up each and every time. So I wanted to make sure that I can see, have a what's called a weighted condition scoring. See, if I have a number of them, I want sort of like market breadth, if you will, to have
Mm,
see what most of them are saying about market conditions rather than rely one. And another reason is that because you can also have um, structural changes in markets, which can, for example, come through legislation, or changes in the market rules, and they can make some indicators obsolete, so they can stop
mm,
working altogether. Again, coming back to the principle of relying not just on one indicator, being a one trick pony. That's why I created the composite. And still, I try to improve these, add, remove, change the components. So to tell you the truth, from a time point of view, most of the time I'm researching rather than trading, because I don't do intraday trading. I have um, my setups. I usually enter long or short above the previous bar high or short below the previous bar's low, and so that's the um, there's a lot of room for me. I try not to check prices intraday, especially my
mhm.
P&L. So most of the time I spend trying to improve my tools.
So is that your entry model, like a price action trigger? Is it close above or below a prior bar, high or low?
Yeah, yeah. Of course, that's the last part. I mean, for example, I have my setup
Hmm.
on the weekly chart. Then I look at what goes on the daily chart from technicals, and then when everything lines up, um, and I think that the market is ripe for um, an increase or a decrease, and to rise or fall, then I enter my orders. I mean, I could show a chart. I don't know if that would probably make sense.
Yeah, we'll get into it. I just wanted to ask about, because you brought up something I didn't ask you enough about when we originally spoke, and this is the idea of the core and satellite approach that you have. So I know you mentioned at the start of this conversation, but I think a lot of people associate experienced traders like you, like you're moving all of your moving all of your money with futures, as in trading futures the whole time. But in reality, you have a core portfolio of ETFs that you trade longer term. Is that right?
Yes,
And
correct.
then futures trading provides a kind of uncorrelated return stream versus to kind of collectively give you a more stable
All right.
return.
So let me again relate it back to the topic which is on trading edges. A big edge. Well, it's not an edge per se. It's like a more of like an inefficiency. Is that there is a bias, an upward bias for equity indices, or and that's why it's so difficult to beat, buy and hold, because
Hmm.
equity indices, especially these are cap weighted, they have an inherent bias, upward bias. So that's why it's so not only difficult to outperform, but also very difficult to be a short seller. But that also puts an advantage in our case, because the average annualized return of, say, the S&P 500 is around 9 to 10%. Of course, you have to have 50% drawdowns on that, but by and large, there is an upward bias on that. So if you manage to capture some of it, um, that is an edge. That's an inefficiency, a market inefficiency, because it's biased to the upside. So you can capture that by having long-term positions. Now you can either do that through individual equities or equity indices, and for many reasons I prefer equity indices. So that can be a part of your core position. So you can have a large part of your cash of your portfolio on long-term investing, if you will, on with ETFs, because and that's one reason. The second reason is because futures trading is not hugely capital intensive. It's a capital efficient way, because you just requires a margin, so you have a lot of um, uh, cash sitting around. Now, obviously, for example, like CTAs who do trend following with futures, the cash that's not in margins, they use basically treasury bills or some kind of a laddered bond approach. Basically anything that's related to that. But I've seen funds who do that. So they have long-term strategies to make sure the cash that is sitting around not in futures get also better invested. And one way is again the upward bias of equity indices. So you can have a long-term position on equity in indices. You can do long-term trend following. There are many ways to do it, but um, you can use that part of your portfolio which is not in futures trading in having some long-term positions, which will be good because it's also provide an uncorrelated income stream.
Hmm. And those longer term ETF positions, you see you can have trend following strategies or whatever. Do you follow the same process using the business cycle or and sentiment and technical setups for your longer term ETF positions, or do you have a different
No, it's a
approach
different
to
it's a
those?
different approach. It's a different approach because the data are different. The commitment of traders report is a week. It's a data that comes weekly. So I don't. I mean, of course, you can only see it from the monthly chart, but I don't use that. So that's why the multiple time frame, multiple factor approach uh, goes to see the factors that are the return drivers for that particular time frame. So I use that for the monthly chart as a setup for the weekly, and then the weekly for the daily. So I look at different. So I have one time frame for as a setup, and then the other one for execution. The same thing for so the commitment of traders report is basically a setup on the weekly chart for my daily trading. So I don't use it for long term position. At least I haven't. Or let me phrase, I haven't found a way to use it for long term positions. So because I want to be careful how I be phrasing things between it doesn't work with I can make it to work. I haven't found a way. Maybe some probably smarter than me can find a way to do it. I don't wanna be discouraging from going down that route. I haven't found it. So I use other techniques on the monthly chart.
Hmm. So for those longer term ETF positions, you trade off a monthly chart.
The setups are on the monthly, the execution is on the weekly.
Right. And this setup is like typical trend following technical setup, or does it
Uh,
also have multiple
that's
factors?
that's a good point, right? In in general, I think it's best if someone filters out trend following with some kind of a fundamental filter. Now, trend following by and large works, but it will be very, very difficult to find something that is more than 35-40% accurate. And you have a lot of drawdowns because of that. But if you filter it with some kind of a predictive factor, something like, for example, like fundamentals, then you can be a bit more selective rather than just fully reactive. It went up, for example, across the moving average, because markets are not that random, in the sense that, for example, a breakout that is combined with something real, like, for example, say moving average on, I'll just give you a very simple system. It's not mine. It's by it was first created by a gentleman called Martin Pring, which I had the pleasure of meeting as well. Okay, see, he did a very, very simple system. Say, okay, S&P 500 is above its moving average. Short-term rates are below their moving average. Get long this, and you get pretty good returns just by a very, very simple exercise like that. It won't beat buy and hold, because a lot of times the S&P will be rising without interest rates being down, but then you can improve it by adding other factors, like 5 or 6 factors, so you're not just relying just on one. But the point I was trying to make, if you compare, say a trend following, purely trend following strategy by the S&P 500, when it's, say, above a, I don't know, a 50 bar moving average on the, or a 12 bar moving average on the monthly chart, filtering it out with short-term interest rates, you'll get better returns and lower drawdown. And if you add 3 or 4 more filters, so if one fails you, that you've got another 3 or 4 ones to filter out the breakout, then you're much better off. So there is a trend following component, but it's fundamentally filtered. It's not just, if it goes up. I mean, you can go fully trend following. There's nothing wrong with that. It's just that, there is a cost to it. And as a private trader, I'm not a fan who will be trading uh, billions, and I have to be more selective.
Yeah, I really like that though, as in just taking that as the base setup, but then looking for maybe it's your inter-market relationships or maybe it's your economic statistics, etc. to to filter the noise and what's a clear signal. Um, so thank you for that.
Especially with intermarket analysis, you can create a lot of filters. Which, again, the good thing about intermarket analysis is that it is market generated data. And of course, correlations change. There may be shifts, so obviously you have to be on your toes. It's not as easy, like, that's why I'm always, I consider myself semi-systematic, trying to combine both the discipline of systematic trading, but also the value of discretionary trading, because unfortunately for us, things change. But some relationships, have held the test of time, and you can kind of like rely on these.
Hmm. Yeah, I've actually I'll have to have you back on the podcast because I have got loads of stuff I want to talk about, but none of it is to do with this Edge Builder series. So let's get let's bring everything together now and pick up
Absolutely.
an example of how you kind of synthesize from the business cycle to something you use on the weekly to the daily setup and then all the way through to even maybe a trigger for a trade you have on or a trade that maybe not one you have on, I guess, but maybe one you've done previously.
All right. Okay. So, right, I just had the S&P 500. Feel free. No, basically, this is my investment universe. I just do my analysis on this one. I don't trade through um TradingView, so I don't have real-time prices on TradingView. I don't need to, because this is end of day. I have my trading platform for that. So TradingView is just my charting platform, and then also use AMI Broker for backtesting. So this is my setup. Again, so what I have is, you can see this is my investment universe. So I've got equities, second fixed income, FX, commodities, and then also have crypto. And which is number 5? Yeah, because then I have got also yeah, central, and I look at central banks, the short-term rates, and then crypto and
Mm.
economic statistics. Now, each of these is further segregated with futures markets. Futures markets I'm following, cash markets, and ETFs. Or if I go to, for example, to FX, I've got these. Let me close this so I can open them up. I got it under Europe, Europe, pound, Swiss franc, and all these are the currencies for in Europe. Also have the commodity dollars, Australian, Canadian, and New Zealand, and then various others. I've got the dollar index, Brazilian real, Japanese yen, Mexican peso, euro yen. Also have in Europe euro British pound. So these are the major ones I'm looking at. Basically, I've got futures on it, liquid futures, because some I have to leave out because of bad, you know, not decent volume. And then commodities, I've got it under indices, various indices, and then I've got the various sectors. So it's energy, metals, which is precious, gold, silver, platinum, and palladium. Industrials, basically, I just have copper on that. Grains, various grain markets I look at. For example, corn. I have a setup on that one. Wheat, and then I look at the soy complex, softs, and then livestock. And lastly,
Yeah.
but not least, crypto. And that's it. Basically, this is my investment universe.
Hmm.
And let
That's
me go. Mhm. Please go
yeah, I
ahead.
was just going to ask. So that style of chart, is that line charting?
Yes, it's bar charting. It's bar
Bar
charting.
charting. Sorry. Yeah.
Now, in theory, I mean, I could be using this as a line chart on the because I mean, I strictly don't need the bar chart, that kind of detail. So you pick a market, then I can show you what. So, for example, I've got wheat here. Um, all right, so this is my usual setup on the weekly chart for my short-term futures trading. Now, this is the panel first you're looking at. And again, this is a random market. I'm not cherry picking it. You feel free to, because I don't want to be fooling you or your audience with something that worked greatly. What I'm about to show you, of course, is the stuff that worked and the stuff that didn't work, because that's life basically. So you let me know your favorite market, and we can look at it. We can look at wheat, or let's pick a popular market. I don't know, gold or whatever you want to. Just pick a market that we can look at.
And do you apply these in FX markets?
Yeah, sure. Let's go.
Yeah.
Let's go
Well, let's
FX.
go with
Which one do you want
let's
to
go
go
with
for?
let's go with dollar yen. Oh, sorry, it's futures. Yeah, the yen.
The yen. All right, let's go with the yen.
Yeah.
All right. All right. So this is the yen futures.
Mhm.
All right, so this is yen futures. Let's see what. Let me explain actually what we've got on the top. I've got the top panel. I've got yen futures. Second,
Yeah.
I've got commitment of traders report. The red line is the commercials. The blue line is the large traders. I can also look at open interest and the small specs as well.
Mhm.
The second is one of the sentiment indicators I use. The crowd sentiment index, and then I look at this is the composite sentiment index. So so this is the composite sentiment index. Obviously, it's got the crowd as well and other sentiment indices as well. So how does all this information, and then later I'll show you the how I apply technicals and seasonality. So this is my setup chart, okay, the weekly chart. These arrows, these are not signals, these are setups, okay. These correspond to the commitment of traders report. And these are either major sell setups, i.e. they're with a big arrow, or minor sell setups, which is with a small arrow. Usually the major ones produce bigger moves. So for example, like this. And as you can see here, now this may not seem like a big move, but don't forget, this is the weekly chart. So you can see here the market fell 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks, right? So these are huge moves. Now, uh, because the commitment of trade report will not always produce unfortunately, a setup. I also use market sentiment as well, and market sentiment comes basically, and I have to change the color coding here because when it's below zero, the market sentiment, I call it relief, and then it's optimism, and then it's greed, and then it's worry, then it's fear, and right at the end it's panic. So I've got this 6-stage model, and it's color coded. So you can see right at the end when it's greed, the bars turn blue. So again, greed here. Now here it's still, greed is slightly early, but it's not perfect. So as things stand here, we had a minor sell setup based on the commitment of traders report. And you can see that the next week, which is basically the week we're going through, this is a Friday, the market kind of like responded to it.
Yeah, so I can see the commercials and the large speculator kind of positioning on those blue and red lines, and I know you mentioned that's generating the signal, but can you give an idea about kind of broadly what kind of logic you would use to generate that signal? Is it the rate of change? Is it the crossover? What kind of things do you look for?
That's a good question, but I'm afraid it's too good of a good question.
We
It
can answer
well,
off
yeah,
camera.
yeah, yeah. Well, there are patterns you can. Well, let's just say commercials have a particular patterns that they follow based on the data to signal a change. I really wish I could say more about, because if I just saying more and more, it's too proprietary. I mean, it's spend a lot
That's
of
okay.
time trying to figure it out, because the thing, as you can see here, there was commercial activity, there was commercial accumulation, and then the market bottom, and it was always great for me. For example, here there was huge commercial accumulation, the market bottom, and there was again huge accumulation here again, and there was distribution selling here and the market top. But there was always a problem with me to try to time it real time. I mean, with the benefit of hindsight, I could always say, oh yeah, it looks good, blah 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 blah, but it's not that easy when you're trying to do it real time. So I had to
Yeah.
figure it out how to sort of use a timing element to it.
Mm.
And it took me, I had an aha moment, sort of like the MACDV, if you will, when I
Yeah.
was looking at the MACDV, the MACD, and then I start thinking about, why is it, wrong with it? Why doesn't it, provide? Why is the, for example, the values comparable across time or securities? And I start thinking about it. I follow the same kind of investigative on the indicators, and again, it relates back to the. Let me Right. So I will go back to the chart. I think it relates back to what we said initially. Um, that I'm leveraging basically what I'm good at, which is look at the chart and try to think. I have a very analytical mind, so I'm not very good as an intraday trader. So I basically looked at the data and tried to understand what makes the commercials tick. So I kind of
Mm.
like reverse engineered that into with a, I would say fairly good. It's not excellent, it's not perfect, but a fairly good result. I mean, commercials are not perfect themselves, because you can see a lot of sometimes you can see patterns which are, for example, the market is selling. They usually buy, and then they see that they were wrong, so they have to reverse it. And then you have explosive moves. That's another pattern for you. When
Mm.
basically you see the correlations between the markets and commercials changing, and then you have
Yeah.
explosive move because you have the funds buying and then the commercials trying to cover their positions. But it
Mm.
explains a lot of market movement. Again, let me go back to the chart if you want.
Yeah.
And
So, but yeah, that's, I mean, that's kind of, you've answered the question there. It's like you're looking for patterns in the commercials and large speculators, and then
Yep.
look for repetition, and then see if it's got something. I mean, there's an element you can't. I think even if you gave someone the answer, I don't even know if it's going to be that good for someone, because sometimes when you get the right answer to something given to you, you don't really appreciate it. So I think people will have more
Exactly.
utility
And
taking
and
some
plus, to tell you
one
the
of your
truth, I mean,
ideas.
it's a trying to discover this. It's a learning experience, and the
Mm,
to be completely honest, the satisfaction I got from figuring stuff out, the emotional, if the satisfaction I get is a lot more than the financial one. At least from my point of view, someone may be more driven by financial rewards, but I just love this game, to tell you the truth. And I've always said this, you know, pick a job that you want to be willing to do for free, and I will be doing this for free. And for me, trying to figure these things out is it might sound like a cliche, but it really is like a passion. I fell in
mm,
love with the stuff ever since I first met it in my last year in university in 1995, 96. So it's been a real passion of mine. So try to learn and learn from others. I had the pleasure of meeting, probably the best technicians in the world: the Larry Williamses, the Tom DeMarks, the Linda Raskis, John Bollinger, and a lot more who are not more that household names. Um, and I've had the pleasure of learning a lot from them and other technicians as well. And either I met them or just read their work and try to encapsulate it and make it mine and add a bit of my own touch as well.
mm. Yeah, that's it. I think even the idea of, I think you mentioned earlier, looking at interest rates or inflation rates, and putting a moving average on it, or putting two moving averages on it, looking at a crossover, taking things and creating your own kind of
Yep,
unique view on it. And it's after I had the first session on the Edge Builder series with Stephen Hold, it's really, I think you have a similar kind of approach. It's quite creative and it's quite unique to you. And I think that's really important when you're creating an edge, because if you do the same thing everyone else does, as you said, maybe a basic trend following system
exactly.
with nothing else
All
there,
right.
you're
Okay.
going to get
So
the same results as
let me
everyone
also
else.
give you a bit of how the system works. Now, as I mentioned, these are setups, and what they do is, as long as they're valid, the bars are color coded in the direction of the setup, and you also have a fail-safe approach to this. So, for example, here I had a major COT sell setup, but you can see this week the market went above that previous bar week, so it was cancelled. Okay, so I have to have some kind of a failsafe, and that's why we were talking before this show started. That I'm getting the impression that there will be some kind of a dollar rally coming. um, Let me explain this and also how failed patterns can sometimes provide informational content. So if we spoke last week, I would tell you that I'm kind of like bearish dollar because I had a lot of COT um, sell setups. For example, this is one of the Mexican peso. Obviously, it wasn't just that. It was also had on the Australian dollar. I noticed the exact same pattern. So we had a lot of again COT setups here. The market didn't respond that well. Canadian dollar futures, again, COT setups. Um, New Zealand dollar, again, COT setups, but the market went above it, above previous bars highs. So I'm getting the impression that we may get some kind of a renewed dollar strength here. Now, of course, what I do is not based on what I think, but on the data. On the pattern. So once I've got that, then I'll switch to the daily chart and start taking my signals there. So again, same thing I had um, on the euro. And this is a setup I had, for example, a few weeks ago. Again, we saw a lot of commercial selling. Um, Again, uh, the crowd sentiment index was showing a lot of greed. Whoops,
Mm,
no, that's the not one. Right, there you go. So the sentiment composite also was showing a lot of greed. So you can see there were two or three things uncorrelated, showing that you may have a kind of a short-term reversal on euro because that was a minor COT sell setup. So I would go on
yeah,
the daily chart and start looking for entries, and that's how I would
mm,
work. So basically, I do my work on the weekly chart, and it doesn't take me more than a few hours. And to do that, and then go into the daily chart for the execution. So setting the setups, it's very, it doesn't take long for me to check this.
So this, because I mean, we can talk about the dollar a little bit, but I'll try and keep myself on task. So this euro setup you took, first thing I want to ask is the signals you're getting here on the
Mhm.
weekly, when do they form? Can they form at any point during the weekly candle? Do they form before the week, on the Monday when the week starts, or is it, or a
No,
Friday?
they form on the close of each week based on the COT data and other stuff. I mean,
Mhm.
I usually check the weekly setups on a Saturday.
Yeah.
So
So,
my day begins on a Saturday. I mean, you could do it on the Monday, and then Monday through. So for example, because we're filming this 6th of June, which is Friday. So as of the close today, for example, tomorrow on the 7th of June, which is Saturday, I will be checking my weekly setups, and then on Monday I'll start purely checking the daily chart.
okay. Okay, good. Um, okay, so let's drill into this euro trade then, for example, or because I assume that's one you've taken over the last couple of weeks.
That is, well, my best setups are major, not minor signals. That was a major, which basically major and minor means that it's counter trend. So because not all signals are, have carry the same weight.
So
So let's
major
go.
being pro trend, is it?
Yeah, I
And
mean there are other factors to it as well, but by and large means that you're going with the trend.
yeah, okay, good.
Or yeah, so again, do you want to stick with the euro, go S&P, whatever, whichever
Yeah,
market, or we can
yeah.
go with commodities.
Let's stick with the euro because
All right,
I'm an FX person at heart. So yeah,
absolutely.
we'll drill into the daily then.
Okay, and I, again, mention these are setups. These are not signals. I mean, they show us buy and sell, as
Hmm.
pointy arrows, but these are setups, which means once I've got that, and then I've got a few more weeks going up, then I go to the daily chart, and or for example here I go to the daily chart for sell signals. Now I'm going to the daily chart looking for sell signals,
Yeah, yeah.
and as long as that, uh, it's one of the two things that will provide directional bias. So the macros on the weekly chart, and then I go into the daily chart working for confirmation, because this is a bias, a setup. So what I want is actually not just the market telling me that it will fall or rise, but go into the daily chart and then actually do so. So
Hmm.
for example, here it had a major buy signal and then it worked very well. Here I had a major sell signal and it didn't work. It was canceled, the next week, basically in a quite spectacular way, and it continued rising again. So that's why there is a lot of informational value on failed signals if they fail immediately.
Hmm.
So again, I had a minor sell setup here, went down for 3 straight weeks. Now it's rebounding back. But strictly speaking, from a setup point of view, I should be looking for uh, uh, sell signals. Now, and then what I'll do is go to the daily chart. And this is exactly what I would do. I would go to the daily chart when I check out the trend, which is basically an 8-stage model. I've got it color coded, stages
Hmm.
1 to 8. So basically, again, will take some time for me to try to explain. But I don't believe that just uptrends and downtrends, because within an uptrend you've got uh, also counter trend moves. So you've got short corrections, and then you've got more long-term corrections within an uptrend. And then when an uptrend, you also have an emerging uptrend, and then you have an established uptrend. So by and large, within an uptrend, you've got 4 phases: emerging uptrend, established uptrend, and then you've got a short-term correction and then a long-term correction. So you've got 4 phases. 4 phases to the upside, 4 phases to the downside, 8 stages in total. And I've got this color coded. So once I've got my weekly sell setup, I go to the daily chart and then I wait for weakness on the daily chart. Also, I will also check the seasonals on that one to see if they're confirming this. So by and large, I will go with a weight of the evidence approach. I will look at the trend, then the world famous MACD to check out momentum, if there are any extremes, divergences, or other patterns. This is another one. This is the volatility valuation index, and it works very, very great. At extremes, it pinpoints reversals. And I learned this from John Bollinger himself. He once told me, low volatility is where trends are born, high volatility is where they go to die. And I usually take this in conjunction with the MACD. And you can find when there are extreme volatilities, it usually signals here. For example, here where I've got my cursor, you can see extreme volatility, market top, extreme volatility, market bottom, extreme volatility, market top, again, extreme volatility, market top. Volatility is a bit trend agnostic. I know there is a bias to equities for high volatility to be associated with bottoms. Again, high volatility market bottom, but not for the rest of the markets. Actually, in commodities, it's the reverse. Usually, tops are high volatility events and bottoms are a bit more quiet. It's the reverse of what happens in equities.
Okay.
So once I've got that, then I look for the market to confirm, basically through the trend and momentum. And the idea is, okay, so you've got a sell setup on the weekly chart, but does the market agree with it on the daily? And when it does, then I'll start taking my signals. And how do I do that? Again, very systematic. Go to indicators. I've got smart signals. Now, I got my signal generating mechanism here. Now, you've got both short and sell signals, but I won't be doing everything. So when I've got a bias, I will just pick, sorry, do that. I will just pick, show buy signal or show sell signals, depending on my bias. So if I have a bearish bias, I'll go obviously show sell signals, and I'll be waiting for the market to start selling it. So I won't be looking for a buy signal, because a signal for me it's nothing without some kind of context, or from a macro or on the daily chart. So once I've got everything, then I look at either to buy or short, depending on my bias. Hope that makes sense.
It does make sense. So each phase here you've highlighted, the 4 phases for, say, an uptrend. You have a signal in each one of those phases that is timing the best, the best time ideally to enter a short.
The signals are irrespective of the stages. It just happened here that we've got one here, one here, one here. No, it's completely random.
Right.
Yeah, we can look at any
Based on
chart.
other factors.
Yeah, no, the signal generating mechanism is just creates that, just signals, buy and sell signals. It's up to us to choose which ones, obviously, the direction you want to be taking. So, for example, if you had a long bias, and then you would be, let me put another example here. So, for example, the market was falling from here to here. If, for example, some kind of a reason you had a long bias here, you would be waiting for the market to change to an upward market stage, which is stage 7. So basically, stage 7, 8, 1, and 2. And these are also color coded with light blue and dark blue, and then light green, and then dark green. And the bearish stages are sort of like the colors we see with the lights on the streets. It's yellow, orange, red, and dark red. So these are the bearish stages. So the bullish stages are, green, light green, and then I've got also, good blue. So once I've got that, then means that you can start looking for buy signals. Or
And
if you were, go ahead.
No, because I've never seen anything like this, if I'm honest. So it's really interesting for me. So say, for example, you get your signal to get long, and you've this trend kind of color, this trend structure is
Correct.
changing from a downtrend into the start of an
Again.
uptrend
Yeah, everything
into
has to be
zone
rules based.
7.
Again, everything has to be
Yeah.
rules based.
At what point is zone 7 confirmed as an uptrend? So what point does it
Based,
change
well,
color?
I use the based on the formulas I used. Again, these are proprietary. Um, I don't use moving averages and stuff. Although I have created an improved version of a moving average.
Hmm.
Well, actually, through this came through the use of a moving average. So this is what I call the smart move 200 bar moving average. So as well, that basically came from when I saw prices being above the moving average bullish, then below bearish. But then I start seeing that when you're above it, you can have counter trend moves, and then you
Hmm.
have impulse moves and the counter trend moves. But all these are bucket classified as being bullish. Well, actually you're not. So I then had to try to reverse engineer that and say, okay, I won't be using moving average, although you can use that, the smart 200 bar moving average, and I use something a bit more effective.
Yeah. Okay. Got it. Okay. And so, I mean, that kind of completes the picture then.
Yeah, then I go from the weekly to the daily chart. Again, I'm launching, as I mentioned. Perhaps I'll do a bit of a commercial plug. I have a community which I'm launching. I've done a low key launch for a community which I'm showing all that stuff, just sharing my work. We have basically, it's called the Smart Trader Systems. It's a trader development system I've created to take you the 5 stages of trader development, and it's got courses, coaching, community, and closed code indicators. Basically, the indicators you saw. The course will be for free. Um, because I think information is important, but it's not the most important thing in the sense that someone needs to apply that information. So I don't have problem sharing the course will be for free, and the rest can, if someone we can join us in the community.
No, I think it's, I mean, I can't echo it enough. And to be honest, I don't think I need to echo it for people that have watched to the end, seeing the rigor in your process. And it kind of just makes sense, right? The way when you start off by talking about your edge as something where you take the directional bias and the reason things move. You're not predicting, you're looking for tendencies in data that are based on price drivers and then technicals for timing, and then everything is rules based. For me, I think you would be a perfect person to start your journey with or improve where you are now. I somewhat wish I knew you when I started, but I suspect I would have had to learn all my own mistakes pretty early anyway, regardless of who I met. But yeah, I can't echo it enough. I mean, the free course, as well as access to someone like you with your systems, I think would be fantastic. So I will get a link. Hopefully, we have one where people can take people at least to your mailing list if you're not ready to take
Yeah,
people
yeah,
on board.
absolutely. I mean,
Um,
I've done the a low key launch now, but people can email me. Perhaps you can send them my email, and then they can contact me, and they can get on my email list and get the official launch. Because right now I'm doing a founding members launch just for a little while. But sure, they can email me, and then I'll be more than happy to show them around.
yeah, super. Okay, Alex. Well, thank you very much for that. I've completely missed my timing cue as always, and I've let this run on much longer. But I'll edit it down. But I'll also keep trying to keep most of it. I really appreciated how open you were in that session. I learned a lot, and there's things and ideas I have that I want to take away now. So yeah, I'm as always happy to talk to you, and I hope people got a lot out of this session.
Absolutely, my pleasure, Tom. It's very nice to be talking to you. I hope you enjoyed this chat we had again, and looking forward to having other ones as well in the future.